Hi guys, welcome to my channel. So before we get started, make sure to hit that like button, also subscribe to my channel. 10 best investments right now for any age or income. The term investing may conjure images of the frenetic New York Stock Exchange, or perhaps you think it's something only meant for those wealthier, older, or further along in their careers than you. But this couldn't be further from the truth. When done responsibly, investing is a great way to grow your money. And many types of investments are accessible to virtually anyone regardless of age, income, or career. For example, someone close to retirement with a healthy nest egg will likely have a very different investment plan than someone just starting out in their career with no savings. 1. High-yield savings accounts. Online savings accounts and cash management accounts provide higher rates of return than you'll get in a traditional bank savings or checking account. Cash management accounts are like a savings account checking account hybrid. They may pay interest rates similar to savings accounts, but are typically offered by brokerage firms and may come with debit cards or checks. Best for savings accounts are best for short-term savings or money you need to access only occasionally. Think an emergency or vacation fund. Transactions from a savings account are limited to 6 per month. Cash management accounts offer more flexibility and similar, or in some cases, higher interest rates. 2. Certificates of deposit. A certificate of deposit, or CD, is a federally insured savings account that offers a fixed interest rate for a defined period of time. Best for a CD is for the money you know you'll need at a fixed date in the future, e.g., a home down payment or a wedding. Common term lengths are 1, 3, and 5 years, so if you're trying to safely grow your money for a specific purpose within a predetermined time frame, CDs could be a good option. It's important to note, though, that to get your money out of a CD early, you'll likely have to pay a fee. 3. Money market funds. Money market mutual funds are an investment product, not to be confused with money market accounts, which are bank deposit accounts similar to savings accounts. When you invest in a money market fund, your money buys a collection of high-quality, short-term government, bank, or corporate debt. Best for money you may need soon that you're willing to expose to a little more market risk. Investors also use money market funds to hold a portion of their portfolio in a safer investment than stocks, or as a holding pen for money earmarked for future investment. While money market funds are technically an investment, don't expect the higher returns and higher risk of other investments on this page. Money market fund growth is more akin to high-yield savings account yields. 4. Corporate bonds. Corporate bonds operate in the same way as government bonds, only you're making a loan to a company, not a government. As such, these loans are not backed by the government, making them a riskier option. And if it's a high-yield bond, sometimes known as a junk bond, these can actually be substantially riskier, taking on a risk profile that more resembles stocks than bonds. Best for investors looking for fixed income security with potentially higher yields than government bonds and willing to take on a bit more risk in return. In corporate bonds, the higher the likelihood the company will go out of business, the higher the yield. Conversely, bonds issued by large, stable companies will typically have a lower yield. 5. Mutual funds. A mutual fund pools catch from investors to buy stocks, bonds, or other assets. Mutual funds offer investors an inexpensive way to diversify, spreading their money across multiple investments to hedge against any single investment's losses. Best for if you're saving for retirement or another long-term goal, mutual funds are a convenient way to get exposure to the stock market's superior investment returns without having to purchase and manage a portfolio of individual stocks. Some funds limit the scope of their investments to companies that fit certain criteria, such as technology companies in the biotech industry or corporations that pay high dividends. 6. Index funds. An index fund is a type of mutual fund that holds the stocks in a particular market index, like the S&P 500 or the Dow Jones Industrial Average. The aim is to provide investment returns equal to the underlying index's performance, as opposed to an actively managed mutual fund that pays a professional to curate a fund's holdings. Best for Index mutual funds are some of the best investments available for long-term savings goals. In addition to being more cost-effective due to lower fund management fees, index mutual funds are less volatile than actively managed funds that try to beat the market. 7. Exchange-traded funds. Exchange-traded funds, or ETFs, are like mutual funds in that they pool investor money to buy a collection of securities, providing a single diversified investment. The difference is how they are sold. Investors buy shares of ETFs just like they would buy shares of an individual stock. Bets for? Like index funds and mutual funds, ETFs are a good investment if you have a long time horizon. Beyond that, ETFs are ideal for investors who don't have enough money to meet the minimum investment requirements for a mutual fund because an ETF share price may be lower than a mutual fund's minimum. 8. Government bonds. A government bond is a loan from you to a government entity, like the federal or municipal government, that pays investors interest on the loan over a set period of time, typically 1 to 30 years. Because of that steady stream of payments, bonds are known as fixed income security. Government bonds are virtually a risk-free investment, as they're backed by the full faith and credit of the U.S. government. The drawbacks? In exchange for that safety, you won't see as high of a return with government bonds as other types of investments. Best for conservative investors who would prefer to see less volatility in their portfolio. Bonds offer a ballast to a portfolio, usually going up when stocks go down, which enables nervous investors to stay the course with their investment plan and not panic sell, says Delia Fernandez, a certified financial planner and founder of Fernandez Financial Advisory in Los Alamitos, California. 9. Dividend stocks. Dividend stocks can provide the fixed income of bonds, as well as the growth of individual stocks in stock funds. Dividends are regular cash payments companies pay to shareholders and are often associated with stable, profitable companies. While share prices of some dividend stocks may not rise as high or quickly as growth stage companies, they can be attractive to investors because of the dividends and stability they provide. Best for any investor, from first-timer to retiree, though there are specific types of dividend stocks that may be better depending on where you are in your investing journey. Young investors, for example, may do well to look into dividend growers, which are companies with a strong track record of consecutively increasing their dividends. These companies may not have high yields currently, but if their dividend growth keeps up, they could in the future. 10. Individual stocks. A stock represents a share of ownership in a company. Stocks offer the biggest potential return on your investment while exposing your money to the highest level of volatility. These cautionary words aren't meant to scare you away from stocks. Rather, they're meant to guide you toward the diversification that buying a collection of stocks through mutual funds provides, as opposed to buying individually. Best for investors with a well-diversified portfolio who are willing to take on a little more risk. Due to the volatility of individual stocks, a good rule of thumb for investors is to limit their individual stock holdings to 10% or less of their overall portfolio. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go.